Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with.
Welcome again. Today we are going to study. Take your book, your notebook, whatever you use to study, and let's go ahead and make it happen. All right. So let's get to work. The senior accountant for Carlton Co., a public company with a complex capital structure, has just finished preparing Carlton's income statement for the current fiscal year. While reviewing the income statement, Carlton's finance director noticed that the earnings per share data has been omitted. What changes will have to be made to Carlton's income statement as a result of the omission of the earnings per share data? Carlton's income statement will have to be revised to include the earnings per share data. Okay, so Step 1. What is the question really asking? The senior accountant for Carlton Co., a public company with a complex capital structure. Translation: public company, shares trade publicly. Complex capital structure, there are potentially dilutive securities, options, warrants, convertible bonds, convertible preferred stock, etc. When you see complex capital structure, your brain should immediately think basic EPS and diluted EPS. Has just finished preparing Carlton's income statement. Translation: the income statement is already prepared. The financial director noticed that the earnings per share data has been omitted. Translation: the accountant forgot to include EPS. The issue is not calculating EPS. The issue is, can a public company leave EPS off the income statement? What changes will have to be made to Carlton's income statement as a result of the omission of the earnings per share data? What must be done to fix the income statement? The key for rule for a publicly traded company: earnings per share is required on the income statement. Think of EPS as mandatory information. If EPS is missing, income statement is incomplete. It must be revised. A memory trick: when you see public company plus income statement plus EPS omitted, immediately think the statement is incomplete and must be revised. Why does complex capital structure matter? Because simple capital structure, only basic EPS required. Complex capital structure, both basic EPS and diluted EPS required. So the question writer is giving you a hint. Hey, this company probably needs diluted EPS too. Step 4. Evaluate the answer or the answers. All right, that makes sense. The following information is relevant to the computation of Farm Co's earnings per share to be disclosed on Farm's income statement for the year ending December 31st. Net income for year 2 is $800,000. 4 million face value 10-year convertible bonds outstanding on January 1st. The bonds were issued 4 years ago at a premium that is being amortized in the amount of $28,000 per share. The stated rate of interest on the bonds is 8%, and the bonds were issued to yield 7%. Each $1,000 bond is convertible into 70 shares of Farm's common stock. Preferred stock, $10 par, 4% cumulative, 15,000 shares issued and outstanding. No dividend is declared for year 2. Farm's corporate income tax rate is 20%. What amount should be used as the numerator in the fraction used to compute Farm's diluted earnings per share, assuming that the bonds are dilutive securities? So we need to understand this question. It's Let's get an explanation of this question. All right, so this question is another EPS question. Following information is relevant to computation of Farmco's earnings per share (EPS) to be disclosed on firm's income statement for the year ending December 31st. Net income for year 2 is $800,000. So we always start with the net income. We have $4 million face value 10-year convertible bonds outstanding on January 1st. Okay. The bonds were issued 4 years ago at a premium. When the bond is issued at a premium, we need to subtract. Remember that if the bond is issued at a discount, we need to add. If the bond is issued at a premium, we need to subtract. Okay, the amortization. At a premium, that is being amortized in the amount of $28,000 per year. The stated rate of interest on the bonds is 8%, and the bonds were issued to yield 7% each. 7%. All right, so in this case here, we have $4 million face value 10-year convertible bonds outstanding on January 1st. We have $28,000 amortization, and we have 8%. So what we're going to do is multiply the $4 million by 8%. 4 million times 8% is going to give us that number. Let me go ahead and do it. Chat is not responding. I may have to get another one. Okay. So we have $8 million, 4 million times 8%, 0.08 is $320,000. So we have $320,000 minus $28,000, the amortization, minus $28,000. That's $292,000. Okay, so we are all the way to yield 7%. So here we have each 1,000 bond is convertible into 70 shares of Farm's common stock. We have another part which is preferred stock 10 par. Preferred stock 10 par, $10 par, 4% cumulative, 15,000 shares. So that's another data we need to have. So we have 292,000 plus 800,000. And down here we have preferred stock 10 par, $10 par, 4% cumulative, 15,000 shares. So we're gonna have 15,000 shares times $10. That's gonna be $150,000 times 4%. Okay, let's do that. 15,000 times 10. That's 150,000 times 0.04. That's 6,000. Okay, so we would have 6,000 plus 292,000 plus 800,000. 1,098,000. I think we're missing something. There is something that I'm missing. I'm missing something. Let's see what it is. We're missing something. Let me get chat to respond. Okay, so here we have it with chat. Say step 1, start with net income. Net income is $800,000. Step 2, subtract preferred dividends. The preferred stock is 15,000 shares, $10 par, 4% cumulative. Annual preferred dividend, 15,000 times 10 times 4%, that's 6,000. Because the preferred stock is cumulative, we subtract it when even though no dividend was declared. It's a subtraction here. Okay. 794. Step 3, apply the if converted method for the bonds. For diluted EPS, assume the bonds were converted at the beginning of the year. Assume the bonds were converted at the beginning of the year. If the bonds had been converted, the company would not pay interest. Therefore, net income would increase by the after-tax interest expense saved. Step 4, calculate interest expense. Face value of bonds, $4 million. Stated rate, 8%. Annual cash interest is $4 million times 8% is $320,000. We got that. Cash interest is $320,000. Step 5, add back premium amortization. The bond premium amortization reduces interest expense, given $28,000. So we will do 320,000 minus 28,000, which will give us 292,000. We got that too. Step 6, tax effect. We forgot the tax effect, which is 20%. After tax interest saved, 292,000 times 1 minus 0.20. So that's the formula for after tax is whatever the number is times 1 minus t, 1 minus tax rate, 1 minus 0.20, 20%. So 292 times 1 minus 20% is 233,600. After tax interest is 233,600. Adjust the numerator. Add the after tax interest back to the basic EPS numerator. 794,000 plus 233,600 is 1,027,600. So final numerator for diluted EPS is this. This is the $1,027,600. All right, so you start with net income, subtract preferred dividends, if any, add back after-tax interest expense, cash interest minus premium amortization plus discount amortization, result diluted EPS numerator. A numerator. Okay. What about that information where it says each $1,000 bond is convertible into 70 shares of farm's common stock? Do we ignore that information? No, we don't ignore it, we just don't use it when calculating the numerator. Think of diluted EPS as having two parts. Numerator, earnings, how much profit belongs to shareholders. Denominator, shares, how many shares are we pretending exist after conversion. For the numerator, we ask if the bonds had been converted, what expense would disappear? Answer, interest expense disappears. Therefore, we add back the after-tax interest. That's why we used 320,000 minus 28,000. 1 minus t. The conversion ratio is 70 shares. Has nothing to do with earnings, so it does not affect the numerator. For the denominator, now the conversion ratio becomes extremely important. The problem says each 1,000 bond is convertible into 70 shares. Total bonds 4 million. Number of 1,000 bonds is 4 million divided by 1,000 makes it 4,000 bonds. Each bond converts into 70 shares. So 4,000 times 70 is 280,000 shares. These 280,000 shares get added to the denominator. Okay. So numerator adjustment 233,600. Denominator adjustment 280,000 shares. When you see language like each 1,000 bond is convertible into 70 shares, your far brain should immediately say that's denominator information. When you see 8% bonds, premium amortization tax rate, your far brain should say that's numerator information. Is there an underlying information that I need to know for this to really make sense? So where is that coming from? Help me understand what they are really asking, because it seems like I'm just calculating numbers, but I don't know the story, the backstory of all of that. Okay, a lot of our students memorize, add back interest, add shares, subtract preferred dividend, but they never understand why. Once you understand the story, the whole chapter becomes much easier. What is EPS really measuring? What is EPS really measuring? EPS asks how much profit belongs to each common shareholder. Okay. Imagine farm earned $800,000 and has 100,000 common shares. Then each share gets 800,000 divided by 100,000, $8. That's EPS. Okay? Why does diluted EPS exist? Because some people don't own common stock yet. They own things that can become common stock later. Examples: convertible bonds, convertible preferred stock, stock options, warrants. These people are standing outside the building saying, I don't own common stock today, but I might tomorrow. Investors want to know, if all those people come inside, how much smaller will my piece of the pie become? That is diluted EPS, earnings per share. What's the story with the bonds? Let's tell the real life story. 4 years ago, farm needed money, Instead of selling stock, farm borrowed $4 million from investors. The investors bought bonds. So today, farm owes the bondholders $4 million and pays them interest of every year. Why would investors buy these bonds? Because they have a special feature. The investor can say, forget paying me back the $1,000, instead give me 70 shares of stock. That is what convertible means. The bond can be converted into ownership. What is diluted EPS pretending? The question asks us to pretend, what if every bondholder converted their bonds into stock on January 1st? Not later, not someday, right now. What changes if they convert? That is the key insight. Before conversion, farm owes bondholders money, pays interest. After conversion, farm no debt, no interest expense, because the bondholders become owners. Okay? Why do we add back interest? Before conversion, farm paid $292,000 of interest expense. That reduces net income. But if the bonds had been converted, there would be no debt. No debt means no interest. No interest means income would have been higher. So diluted EPS says, let's pretend that interest expense never happened. That's why we added back. Why do we add shares? Before conversion, the bondholders were lenders. They did not own common stock. After conversion, the bondholders become owners. How many new owners? The problem tells us 4 million divided by 1,000. So we have 4,000 convertible bonds. Each becomes 70 shares. Therefore, 4,000 times 70 is 280,000 new shares. The pizza story. Imagine a pizza today. Profit equals 8 slices. Owners equals 4 people. Each gets 8 divided by 4. Each get 2 slices. Now imagine 2 bondholders convert. Suddenly there are 6 people. But because no interest had to be paid, the pizza gets a little bigger. Instead of 8 slices, maybe now there are 10 slices. Now 10 divided by 6, each person's share is smaller. That is dilution. What is the examiner really asking? The examiner is really asking, if these bondholders stopped being lenders and became owners, what would the company's earnings and shares have looked like? That is why numerator adjusts earnings as if no interest existed. Denominator adjusts shares as if conversion happened. The one sentence to remember: whenever you see convertible bonds, tell yourself, pretend the bondholders became shareholders on the first day of the year. Then ask, what expense disappear? Add back interest numerator. How many new owners appear? Add shares in denominator. Once you see it as lenders becoming owners, the entire diluted EPS chapter starts to make logic sense instead of feeling like a collection of formulas. Okay, that's a long explanation, but it makes sense. Makes sense. So as we look at this, let me ask something else. Show me a whole, not a whole problem, but show me the numerator and the denominator in a problem. How does it look like? Tell me. I know the story, but show me a representation of the numerator and the denominator. Okay. EPS equals earnings available to common stock. Of common stock weighted average divided by weighted average common shares. That's all EPS is. Basic EPS. Suppose farm has net income 800,000, preferred dividend 6,000, common shares 100,000. Numerator 800,000 minus 6,000, 794,000. Denominator 100,000 shares. Basic EPS 794,000 divided by 100,000 equals 7.94. So each common share earned $7.94. Okay. I see. It starts to make sense. Okay. All right, let me see what I had wrong. I said we start with net income, which is $800,000. We leave that here. And then we adjust preferred stock. Preferred stock is $10 par, 4% cumulative, 15,000 shares issued in outstanding. No dividend is declared for year 2. That's fine. So 15,000 times $10, that's 150,000 times 4%, that's 6,000. So what we're gonna do, we will deduct the 6,000 from the 800,000. That's 794. Okay, 794. But we have a 4 million face value 10-year convertible bonds outstanding on January 1st. And this one right here has a 8%. The stated rate of interest on the bonds is 8%. So we will multiply this by 8%. 4 million times 8%. We did that already. I'm just looking to see where I am. 4 million times 8%, 0.08. That's 320,000. Okay. So that's 320. We have the amortization. We will subtract amortization here. Minus 28,000. That's 292,000. 292,000. So now we need to adjust for tax. So this is where we say the tax, farm's corporate income tax rate is 20%. So it's gonna be 292,000 times 1 minus T minus 20%. Okay. And then we add, that's gonna give us the result. I believe it became 233. 1,027,600. Okay, I think it's making sense so far. It's making sense so far. Another question almost the same. The following information is relevant to the computation of Chen Co's earnings per share to be disclosed on Chen's income statement for the year ending December 31st, year 2. Net income for year 2 is 600,000. 5 million face value 10-year convertible bonds outstanding on January 1st. Sorry. The bonds were issued 4 years ago at a discount, which is being amortized in the amount of 20,000 per year. Okay. The stated rate of interest on the bonds is 9%, and the bonds were issued to yield 10%. Each 1,000 bond is converted into 20 shares of Chen's common stock. Chen's corporate income tax rate is 25%. Chen has no preferred stock outstanding and no other convertible securities. What amount should be used as the numerator in the fraction used to compute Chen's diluted earnings per share, assuming that the bonds are dilutive securities? So that's almost the same thing here. We don't have preferred stock. Okay, here we don't have preferred. So we always start with the net income, which is 600,000. Since we don't have preferred stock and income statement says convertible bonds outstanding January 1st, the bonds were issued 4 years ago at a discount. So if the bond were issued at a discount, we will add. If it's issued at a premium, we subtract. Remember the last question, it was at a premium. This question is at a discount. So I believe this is the difference. We start with net income. Net income is 600,000. 5 million face value. 10-year convertible bonds outstanding on January 1st. Okay, we have 5 million. The bonds were issued 4 years ago at a discount, which is being amortized in the amount of 20,000 per share. The stated rate of interest on the bonds is 9%. So what we're gonna do, we're gonna 5 million times 9%. 5 million times 9%. 0.09. We have 450,000. So $450,000 of bond. And we also have the $20,000 per year amortization. Since it was a discount, we will add. So plus 20,000. That's $470,000. I think we're done with this side. Okay, so we need to adjust for tax. The tax rate is 25%. So it's gonna be 470,000 times 1 minus T. 1 minus 25%. 470,000. Let me do 1 minus 25%. 0.25 is 75. So we will have 470,000 times 0.75 is 352,500. We're done with this side. So what we're gonna do, we're gonna add it to 600,000 plus 600,000. I have 952,500. 952,500, which is exactly correct. Okay, that's correct. So it's making sense. Temp Inc. had the following common stock balances and transactions during year 6. Common stock outstanding 30,000. February 1st issued at a 10% common stock dividend 3,000. July 1st issued common stock for cash 8,000. December 31st common stock outstanding 41,000. This is the total. So what do we have? What is the question? What were Tim's year 6 weighted average shares outstanding? So let me get the explanation of weighted shares outstanding. These are all the shares that were outstanding during the year. All the shares outstanding during the year. So January 1st common stock outstanding 30,000. February 1st issued at a 10,000 common stock dividend 3,000. So that will be 33,000. 33,000, because when the stock is issued, it's a stock dividend. You will pretend that the stock was there during the whole year. Okay, now issued common stock for cash 8,000. That was in July 1st. It's not stock dividend. Since it is not stock dividend, you will adjust for the month these stocks were outstanding, which is 6 months during the year. Okay, so here it will give you the result. Let me get the explanation from chat. $33,000 times 12 times 12 divided by 12. 8,000 times 6 divided by 12, and that's what's going to give you, because it's weighted average shares outstanding. All right, it says this is one of the most important weighted average shares outstanding WASO concept on FAR because of the stock dividend. Let's walk through it slowly. Step 1, what happened on January 1st? Outstanding shares 30,000. Step 2, what happened on February 1st? A 10% stock dividend was issued. 30,000 times 10% is 3,000. New shares, we have 33,000 new shares. Now here's the tricky FAR rule. Stock dividends are treated as if they happen at the beginning of the year. Why? Because no new money came into the company. Think of it like this. The company cut the pizza into more slices, but the pizza didn't get bigger. Since nothing economically changed, we restate all prior shares. So the original 30,000 shares become 30,000 times 1.10 is 33,000 for the entire year. Step 3, what happened on July 1st? The company issued 8,000 new shares for cash. This is different. New money entered the company. Therefore, these shares are weighted only for the period they were outstanding, from July 1st through December 31st, which is 6 months. Weight, 6 divided by 12. Contribution, 8,000 times 6 divided by 12, that's 4,000. Step 4, calculate WASO, which is weighted average stock outstanding. Okay, so beginning shares adjusted for stock dividend, 33,000, plus weighted new shares, 4,000. The total is 37,000. Okay. Okay. The story behind it. Think about two different events. Stock dividend, 30,000 shares become 33,000 shares. No cash enters, no assets increase, no business value changes. It's like exchanging one $10 bill for two $5 bill. Same value, therefore FAR pretends those extra shares existed all year. Stock issuance for cash, 33,000 shares become 41,000 shares. The company receives cash, assets increase, the business actually became larger. Therefore, those new shares only count from the date issued. FAR shortcut. All right, so here is the same case. Stock issuance for cash. If you issue stock for cash, it's different than dividend stock. When we talk about dividend stock, it is the split, right? When you split it, no new money comes into the company, just the stock. The stocks become more. The business actually became larger, therefore those new shares only count for the date issued. FAR shortcut. Whenever you see stock dividend, stock split, restate prior shares as if it happened on January 1st. Whenever you see shares issued for cash, shares issued for assets, shares repurchased, weight them by time outstanding. That's why the answer is 37,000 and not 34,000 or 41,000. That makes sense. Let me ask another question. Common stock dividend. Explain common stock dividend. Common stock dividend, I believe it's the split. Explain that in details. Okay, let's start with the story. Imagine you own a company. Suppose the company has assets, $1 million, liabilities, $400,000, equity, $600,000, and there are 30,000 shares outstanding. Each share represents ownership of part of the company. What is a cash dividend? A cash dividend is when the company says, we are giving shareholders money. For example, company pays $60,000 cash. Assets decrease by $60,000. Equity decreases by $60,000. The company becomes slightly smaller. Real value leaves the company. What is a stock dividend? Instead of giving cash, okay, the company says, we are giving you more shares. Suppose you own 100 shares. The company declares a 10% stock dividend. You receive 100 times 10%, you receive 10 new shares. Now you own 110 shares. Did you become richer? No. This is the key. Before you owned 100 shares. After you own 110 shares. But everybody else also received 10% more shares. So your ownership percentage didn't change. Ownership percentage didn't change. Pizza example. Imagine a pizza cut into 30,000 slices. The company issues a 10% stock dividend. Now the pizza is cut into 33,000 slices. Did the pizza get bigger? No. We simply made more slices. That is why FAR treats stock dividends differently from new shares issuance. Why does FAR pretend it happened at the beginning of the year? Because nothing economically changed. No cash entered, no assets increased, no liabilities changed. The only thing that changed was the number of slices. That's why when calculating EPS, FAR restates prior shares as if the stock dividend had existed all year. Stock dividend versus stock split. These are very similar. Stock dividend, example, 10% stock dividend. 30,000 shares become 33,000. No, 33,000 shares. Accounting entry is required. Retained earnings decreases. Common stock and APIC increase. Stock split. Example, 2-for-1 split. 30,000 shares become 60,000 shares. No accounting entry, par value is reduced. Number of shares doubles. Why would a company do this? Suppose stock is trading at $200 per share. Many investors think that's expensive. The company may increase the number of shares after a 2-for-1 split. Shares double, price roughly falls to $100. Now the stock looks more affordable. FAR exam shortcut. When you see stock dividend, small increase, usually under 20%, 25%, restate prior shares. Treat as if it happened at the beginning of the year. Stock split, large increase, 2-for-1, 3-for-1, etc. Restate prior shares. Treat as if it happened at the beginning of the year. For EPS purposes, stock dividends and stock splits are handled almost the same way. The reason is simple. Neither one brings new assets into the company. The company did not get bigger. The pie stayed the same size. It was simply cut into more pieces. Now my follow-up question is, let's see. My follow-up question is, if I had 100 shares in a company and there is a stock dividend, I have 110 shares. That doesn't make me richer. Is this fair? Because if I receive the money, I would receive $10, but now I have 110 shares, but I still have the same amount of money. Is this fair? Okay. All right, that's exactly the question many investors ask the first time they learn about stock dividend. The answer is yes, it's fair because you are not losing anything, but you're also not gaining anything immediately. Let's look at the numbers. Before the stock dividend, suppose you own 100 shares. Each share is worth $10. Your investment is worth $1,000. After 10% stock dividend, you now own 110 shares. But the company did not get richer. The same company value is now divided among more shares. So the stock price roughly adjusts. 1,000 times 100, no, 1,000 divided by 110 equals 9.09. Now you own is still $1,000. You still have about $1,000. Compared to a cash dividend, suppose instead the company pays a $1 dividend per share. You own 100 shares. You receive 100 times 1, $100 cash. But the company just sent $100 out of the business. The stock price usually drops by about the dividend amount. Before stock value, $1,000. After stock value, $900. Cash received, $100. Total, 900 plus 100 is 1,000. Again, you're not automatically richer. So why do investors like cash dividends? Because they receive actual cash. They can spend, reinvest, save. A stock dividend gives no immediate cash. It's more like the company saying, instead of sending you money, we'll give you additional pieces of ownership. A real estate example, imagine you own 10% of an apartment building. The building is worth $1 million. Your ownership is worth 10% of 1 million is 100,000. Now the ownership certificates are split into more pieces. Instead of 100 certificates, there are 110 certificates. You receive more certificates, but you still own 10% of the building. The building didn't get bigger. You didn't become richer. You simply own more pieces representing the same ownership. The hidden benefit, sometimes stock dividends or stock splits, can help investors indirectly. If a stock is $1,000 per share, many people feel it's expensive. After a split or stock dividend, it may trade at $500 or $100 per share. More investors may buy it. Higher demand can eventually push the price up. Okay. But that's because of investors' behavior, not because the stock dividend itself created wealth. So your intuition is correct. I got more shares, but I didn't get more money. Okay. Makes sense. $37,000. The if converted method of computing earnings per share data assumes conversion of convertible securities as of the beginning of earliest period. The if converted method of computing earnings per share data assumes conversions of convertible securities as of the beginning of the earliest period. In the beginning of earliest period, there'd be middle, ending, beginning of the earliest period reported, regardless of time of issuance. Beginning of the earliest period reported, or at time of issuance if later. No, regardless of time of issuance. Beginning of the earliest period reported, or at time of issuance if later. I don't understand that. Conversion date for convertible securities. If converted method, where the security is outstanding at the beginning of the earliest period presented. Yes, date of earliest period reported used. No, date issued is used as conversion date. Diluted earnings per share considers the conversion effects of all potentially dilutive securities. That means convertible into common stock. The if converted method is used for calculating diluted EPS, which assumes any convertible security, example convertible bonds, stock options that could convert to common stock will convert. The conversion stock to stock is considered having occurred at the beginning of the earliest period reported. However, if the convertible securities are issued during the year, the date of issuance is used as the conversion date. Using the correct conversion date is important since it impacts the EPS formula. For example, the after-tax interest expense not paid on convertible bonds will be for a full year if the bond conversion is treated as from the beginning of the year. If the bonds were issued on July 1st, then only half of the after-tax expense is avoided and added back to net income. Things to remember: diluted earnings per share uses the if converted method, which assumes any convertible security, example convertible bonds, stock options. We also have warrant that could convert to common stock will convert. The conversion to stock is considered having occurred at the beginning of the earliest period reported if the convertible securities are issued during the year. The date of issuance is used as the conversion date. The if converted method of computing earnings per share data assumes conversion of convertible securities as of okay, convertible securities, not dividend, not stock dividend. Stock dividend regardless of time of issuance. Okay. Caspella Corp had the same capital structure in year 4 and year 5. In year 4 and year 5, consisting of the following: preferred stock $12 par, 5% cumulative, 20,000 shares issued and outstanding, $240,000. Common stock $6 par, 250,000 shares issued and outstanding, 1,500,000. Caspella reported net income of $600,000 for year 5. No preferred dividends were paid in year 4, but Caspella paid $20,000 in preferred dividends in year 5. In its year 5 income statement, what amount should Caspella report as basic earnings per share? Basic earnings per share for in year 5. Year 4 you didn't pay anything. Preferred stock 12. $12 par, 5% cumulative, 20,000 shares. So 20,000 times 12. 20,000 times 12. Let's 240,000. 5% times 5%. That's 12,000. Okay. Preferred stock. Okay. Common stock. 6 bar. 12,000. Okay. 12,000. Remember that. Common stock 6 bar. 250,000 shares. 250,000 shares. $6 par. Shares issued and outstanding. Okay, that's common stock. Times $6. 250,000 times 6. That's 1.5 million. Okay. Caspella reported net income of 600,000 for year 5. No preferred dividend were paid in year 4, but Caspella paid $20,000 preferred dividend in year 5. In its year 5 income statement, what amount should Caspella report as basic earnings per share? It has a lot of little nuance to it. We need to understand. Understand this. Okay. Let's interpret this like the CPA examiner. Step 1, what are they asking? What amount should Caspella report as basic earnings per share? That means basic EPS, net income available to common stock owners divided by weighted average of what? So immediately your brain should ask, what's the numerator? What's the numerator? What's the denominator? Step 2, find the denominator. Common stock, 250,000 shares issued and outstanding. No stock dividend, no stock splits, no new shares issued. Therefore, denominator is 250,000. Easy. Step 3, find the numerator. Net income is 600,000, but EPS belongs to common shareholders. Preferred shareholders get paid first, so we subtract preferred dividends. Okay, subtract preferred dividends. Step 4, calculate preferred dividend. Preferred stock, $12 par, $12 par, 20,000 shares, 5% cumulative. Annual preferred dividend is 12,000, which is what we found. Okay, so that's annual preferred dividend. Step 5, the trap. The problem says no preferred dividend were paid in year 4. Many students think we owe year 4 and year 5, so subtract 24,000. That's wrong. Why? Because EPS uses the dividend that belongs to the current year's income. For cumulative preferred stock, you subtract 1 year's dividend requirement, whether paid or not. So subtract 12,000, not 24,000. Step 6, numerator, 600,000 minus 12,000 equals 588,000. Step 7, EPS 588,000 divided by 250,000, that's 2.35. Okay. The deeper story, the $20,000 actually paid in year 5 is there to distract you. EPS doesn't care about cash paid. EPS asks how much of year 5 earnings belong to preferred shareholders. Only the year 5 preferred dividend requirement, which is 12,000, belongs to preferred shareholders. The extra amount paid relates to arrears from a previous year and does not reduce year 5 income for EPS purposes. That's why the answer is 2.35. Cumulative preferred stock, subtract 1 year's required dividend, not necessarily the amount paid. Okay. All right, so it's time for break. We will be back in 10 minutes.
Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. May He give you wisdom. Critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp, with a great memory. our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. May He give you wisdom. Critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp, with a great memory. With a great memory. May you pass every exams. Come study with me. Come study with me. Come and study with me. Come study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes.
All right, welcome back. Welcome back. I'm having my breakfast. What I'm eating is some cashew and raisin. That's what I have up for breakfast. It's so good. I was so hungry too. So I needed to get something to eat. Hopefully you got some breakfast too. All right, let's get to work. Okay. Let's go back to the last question. It says that Caspella Corp had the same capital structure in year 4 and year 5, consisting of the following: pre-tax stock $12 par, 5% cumulative 20,000 shares issued and outstanding $240,000, common stock $6 par, $6 par, 250,000 shares issued and outstanding 1.5 million. So Caspella reported net income of $600,000 for year 5. No preferred dividends were paid in year 4. But Caspella paid $20,000 in preferred dividends in year 5. In its year 5 income statement, what amount should Caspella report as basic earnings per share? Okay. Step 1. What are they asking? What amount should Caspella report as basic earnings per share? The earnings per share formula, EPS, equals net income available to commons. Let me get this right. EPS formula. Net income preferred dividends divided by weighted average number of shares outstanding. Net income preferred dividend earnings per share measures a company's profitability per outstanding share of common stock. The most widely used formula calculates basic EPS, representing the portion of the company's profit allocated to each outstanding shares. So net income minus preferred dividends divided by weighted average number of shares outstanding. weighted average. Net income available. Okay. So immediately your brain should ask, what is the numerator? What is the denominator? And second, what is the denominator? Step 2, find the denominator. Common stock, $250,000 shares issued and outstanding. You remember the formula, weighted average shares outstanding. So here they gave us the number is 250,000 shares issued and outstanding, no stock dividend, no stock split, no new shares issued. Therefore, denominator is 250,000. That's easy. All right? So there is no adjustment. No adjustment to be made. Step 3, find the numerator. Net income. Net income exceeds 600,000. All right? But EPS belongs to common shareholders. Preferred shareholders get paid first. So we subtract preferred dividends. All right, minus preferred dividend. Okay, net income minus preferred dividend. That's the numerator. Step 4, calculate preferred dividend. Preferred dividend or preferred stock is $12 par, 20,000 shares, 5% cumulative. Annual preferred dividend is 20,000 times 12, which is $12 par, times 5%, which is the 5% number they gave us. Annual preferred dividend is 12,000. Okay, so 20,000 times $12 par times 5%. That's 12,000. Step 5, the trap. The problem says no preferred dividends were paid in year 4. Many students think we owe year 4 and year 5, so subtract 24,000. That's wrong. Why? Because EPS uses the dividend that belongs to the current year or the current year's income for cumulative preferred stock. You subtract 1 year's dividend requirement, whether paid or not. So subtract 12,000. Okay, not 24,000. Step 6, numerator, 600,000 minus 12,000 is 588,000. Step 7, EPS, 588,000 divided by 250,000, that's 2.35, which is the answer. Okay. Okay. $235. Let me see if I understand that. It says Caspella had the same capital structure in year 4 and year 5, in year 4 and year 5, consisting of the following: preferred stock $12 par, 5% cumulative, 20,000 shares issued out and outstanding, which is a $240,000. Understand. Common stock $6 par, 250,000 shares issued and outstanding. So as you look at this, preferred stock $12 par cumulative shares issued and outstanding, I need to understand that. Hospital reported net income 600,000. Okay. So net income minus preferred. Okay. So the numerator is net income minus preferred stock. Net income minus preferred stock. Dividend minus preferred stock dividend. Okay, making sense. Okay. So that's why we have preferred stock. They gave us the total preferred stock and we need to calculate the preferred stock dividend. They gave us net income. Okay. Okay, let me see if I understand it. Preferred stock, $12 par, 5% cumulative, 20% shares issued outstanding, which is 240,000. And when we do the dividend payment is 5% of 240,000, which is 12,000. Okay, which is 12,000. We have common stock, $6 par, 250,000 shares issued and outstanding. This is 1.5 million. 1.5 million. Okay. $1.5 million. But we divide this by shares. By shares outstanding. So the denominator is shares outstanding, not money. Shares outstanding. The numerator is net income, which is money. Money divided by shares. Okay. So Caspilla reported net income of 600,000 for year 5. No preferred dividends were paid in year 4, but Caspilla paid $20,000 in preferred dividends in year 5. In its year 5 income statement, what amount should Caspilla report as basic earnings per share? I still don't understand these numbers. Okay. Let me go back to this. Step 1. You know the formula, net income. EPS, earnings per share, is net income available to common stock, or net income divided by, minus preferred stock dividend preferred stock. Okay. So immediately your brain should ask, what's the numerator? What's the denominator? Step 1, find the denominator. Common stock. Common stock, $6 par, 250,000 shares issued and outstanding. So 250,000 shares. No stock dividend, no adjustment. No stock dividend, no stock splits. No new shares issued. So this is the denominator, because no adjustment needed. 250,000 shares. This is the denominator. Now let's work with the numerator. Step 3, find the numerator. Net income is 600,000, but we have some adjustment to make. But EPS, earnings per share, belongs to common shareholders. Yes. Earnings per share belongs to common shareholders, not preferred. Okay, not preferred, but common shareholders. Preferred shareholders get paid first. So we subtract preferred dividends. Okay? Subtract preferred dividends. Out of what? Out of the 600,000 net income. All right. Let's go. Step 4. Calculate preferred dividend. Preferred stock is $12 par, 20,000 shares, 5%. This is what gave me the 12%, $12,000. So 20,000 times $12 par times 5%, 12,000. Okay? Step 5, the trap. The trap is the problem says no preferred dividend were paid in year 4. Many students think we owe year 4 and year 5, so subtract 24,000. That's wrong. Why? Because EPS uses the dividend that belongs to the current year's income. For cumulative preferred stock, you subtract 1 year's dividend requirement, whether paid or not. So subtract 12,000, not 24,000. I'm good so far. Step 6. Numerator 600,000 minus 12,000. That's 588,000. So what do we do with this? $20,000 in preferred dividend in year 5. No preferred dividend were paid in year 4, but Caspella paid $20,000 in preferred dividend in year 5. Yes, so there is a piece of information that I need to know what to do with it, because here it says that it says no preferred dividend were paid in year 4, but Caspella paid $20,000 in preferred dividends in year 5. What do we do with this piece of information? Okay, that's excellent observation. This is exactly the kind of detail the CPA exam likes to test. The question is really asking why did they tell me about the $20,000 paid in year 5 if I don't use it? The answer is they gave it to you to see whether you understand the difference between dividends paid and dividends attributable to the current year. Okay. But Caspera paid $20,000 in preferred dividend in year 5. Preferred stock, okay. Let's calculate the annual preferred dividend. Preferred stock, 20,000 shares, $12 par, 5% cumulative. Annual dividend requirement is $12,000. Every year, preferred shareholders are entitled to $12,000. What happened in year 4? No preferred dividends were paid. So now preferred dividend in areas are $12,000 owed from year 4. What happened in year 5? The company paid $20,000 to preferred shareholders. That payment covers year 4, $12,000, part of year 5, $8,000. Total paid $20,000. Okay. Notice something? The company still owes $4,000 for year 5. Yes. Why doesn't EPS use $20,000? Because EPS is not asking how much cash left the company, EPS is asking how much of year 5 earnings belong to preferred shareholders. The answer is 12,000. Okay? Because that's the dividend associated with year 5. Think like rent. Imagine a tenant owes $1,000 rent in 2024, doesn't pay. In 2025, the tenant pays $1,500. How much rent expense belongs to 2025? Still $1,000. The extra $500 relates to an earlier obligation. Same idea here. What is the exam testing? The examiner wants to know whether you incorrectly do 600,000 minus 20,000, which would be wrong, or whether you will recognize only the current year's preferred dividend requirement reduces income available to common shareholders. Therefore, 600,000 minus 12,000, which is 588. A rule worth memorizing: for cumulative preferred stock, basic EPS numerator net equals net income minus current year's preferred dividend requirement. Dividend requirement, not dividends actually paid, not dividends declared, not dividend in arrears, just the current year's required preferred dividend. Makes sense? That's why the information about the $20,000 payment is a trap. It is a trap, my friend. Remember it? The CPA exam wants to see if you understand what part of that payment belongs to year 4 and what part belongs to year 5. Makes sense? Okay. We're getting it. We're getting it. Okay, so the answer is, do you understand it now? Let me see if I do. Caspillo Corp had the same capital structure in year 5 and year 4 and year 5, consisting of the following: preferred stock 12 bar 5% cumulative 20,000 shares issued, outstanding 240,000. So you already know that if we're talking about EPS, you will need to have the dividend, the preferred stock dividend minus net income. That's what's going to give you the numerator. Okay. So you have here preferred stock 240, but it's 5% of this. The dividend of this is 5%. So 5% of 240,000 is 12,000. Good. Done. Now, common stock is $6 par, and the common stock are the shares. This is the denominator, okay, to calculate EPS. Common stock, $6 par, 250,000. This is what gives you $1.5 million. $1.5 million. So check it out. Here in common stock, we don't use the money, we use the shares. When we calculate an EPS, the denominator is not the money, 1.5 million, but it's the amount of shares. So we have 250,000 shares, but there is no adjustment. There is no adjustment. So this is the denominator, 250,000. So now we need to solve for the numerator because there are some adjustments to be made from the $600,000 net income. We start with the net income, $600,000, minus the dividend that is required to be paid for the year, which is $12,000. So 600,000 minus 12,000, what is it? Sorry, my voice is too loud, but this requires a lot of, I can't think it without talking loud. Okay. 600,000 minus 12,000. That's where we have 588,000. This is the numerator. Okay? So this will divide by 250,000 shares. That's 2.35. We understand. Makes sense. Makes sense. Let me feed myself something. Good job. Good job. Okay. That's session 2 out of 3. Session 2 out of 3. Okay. All right. Let's go. Tofco had 120,000 shares of common stock. 120,000 shares of common stock outstanding on January 1st. On April 1st, it issued 40,000 additional shares of common stock. Okay? Outstanding all year were 10,000 shares of non-convertible preferred stock on which a dividend of 5% per share was declared during the year. Net income for the year was $480,000. What should TOF report as earnings per share for the year? Okay. When we're looking for earnings per share, we always need to know that we need the numerator and the denominator. The numerator is the preferred stock, is net income minus preferred stock dividend divided by number of common shares outstanding. Okay, so what do we have? 120,000 shares of common stock outstanding on January 1st. On April 1st, it issued 40,000 additional shares of common stock. So here we have to wait it out. We need to wait this out because 120,000 shares of common stock outstanding January 1st, cool. Issued 40,000 additional shares of common stock on April 1st. So which month is that? That's month 4. So these 40,000 shares, they were outstanding for 8 years, 8 months in the year. So what we're gonna do is 40,000 times 8 divided by 12. 40,000 times 8 divided by 12. So we have 26,666 plus 120,000 plus 120,000, 146,666. These are common stock outstanding for the year. Outstanding all year were 10,000 shares. 10,000 shares of non-convertible preferred stock, on which a dividend of a $5 per share was declared during the year. $5 per share declared, not paid. But we'll talk about this in a minute. Net income for the year was $480,000. So we start with net income. What dividend do we have for preferred stock? Here we're not even talking about preferred stock. Common stock outstanding. Common stock outstanding issued. Additional shares of common stock outstanding all year. 10,000 shares of non-convertible. We have preferred. We had 10,000 shares of non-convertible preferred stock, on which a dividend of $5 per share was declared during the year. So $5 per share, 10,000 shares. 146.66. All right, let me do something. 10,000 shares times 5. That's $50,000. Dividend was declared. So what we're gonna do? This is the preferred stock dividend. So we have net income is 480,000. Let's work on the numerator. 50,000. So 480,000 minus 50,000. So we have $430,000 as numerator. Can write it down. 430,000 as numerator. And put it down back. 430. This pen is not working. Gotta throw it away. Okay, 430. 430,000. 30,000 as numerator. Now, common stock. Common stock. We have 120 plus 40,000 shares. Plus 40,000. I think we got it. We got it. So I had to write this down. So 40,000 shares. We have 40,000 times 8 times 12. No, divided by 12. Times 8 divided by 12. That's 26. Sticks, 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 sticks. 120,000. That's 146,666, which is the numerator. 146. 66. 66. Okay. So watch this. This is shares. We have $430,000 divided by 146. $430,000 divided by 146. 146,066. $100. 66 less. So it's 293. 293. I have 287. I have 287, which is closer to 69. I have 3. And 7 to 93. Which one is closer? I'm gonna say 287. You're learning. You're learning. Praise God. Praise the Lord. You're learning. Praise God. These things are really so interesting. Praise the Lord for knowledge. Praise God for understanding. Yes. If you did it right, feed yourself something. Good job. Okay. I like to hear what you do. During the current year, Conoco had outstanding 25,000 shares of common stock, 3,000 shares of $20 par, 10% cumulative preferred stock, and 3,000 bonds that are $1,000 par and 9% convertible. The bonds were originally issued at par, and each bond was convertible into 30 shares of common stock. During the year, net income was $200,000. No dividends were declared, and the tax rate was 30%. What amount was Commerce basic earnings per share for the current year? We're calculating earnings per share. I think we're about to dominate this and be sharp at this. Really sharp. Calculating earnings per share. need to have in mind, go to the question. The question says, what amount was Commerce basic earnings per share for the current year? So we know that we're calculating earnings per share. And to calculate earnings per share, what we need net income from the numerator. We need net income. We need the dividend from preferred stock, right? So net income minus dividend, preferred stock dividend divided by weighted common shares outstanding. Make sense? Okay. Now that we understand that, let's go for one of these. Okay, so it's like in the current year, Comico had outstanding 25,000 shares of common stock. Okay, 25,000 shares of common stock. 8,000 shares of $20 par. 10% cumulative preferred stock. Okay, so here we have preferred. We have common, we have preferred. Because we know preferred is the dividend. We need the dividend. And 3,000 bonds that are $1,000 par and 9% convertible. The bonds were originally issued at par, and each bond was convertible into 30 shares of common stock. Now we gotta, okay, I see what they're trying to do. See what they're trying to do here. During the year, net income was 200,000. We have net income, $200,000. No dividend were declared. Alright, no dividend were declared. And the tax rate was 30%. Why do I need the tax rate? To make the adjustment. What amount was Commerce basic earnings per share was currently? We have a lot of information, a lot of extra information. So during current year, Comico had outstanding 25,000 shares of common stock. Good. We're still here. That could have been the denominator. But we have more information. 25,000 shares of common stock. 8,000 shares of $20 par, 10% cumulative stock. So we have 8,000 shares. Okay, let's just calculate this. This is what we're calculating the dividend. Calculating the dividend. 8,000 shares of $20 par. So we're gonna do 8,000 times 20. 8,000 times 20. That's 160,000 times 10% times 0.1. $16,000 dividend. The dividend is $16,000. And if we want to continue for the numerator, we will do 200,000 minus 16,000. 200,000 minus 16,000. So 184,000. That could be the numerator. 184,000. Okay. 184. So let's work for the denominator now, which is a little complicated. $25,000 shares of common stock. Okay. And then we have 3,000 bonds that are $1,000 par and 9% convertible. The bonds were originally issued at par, and each bond was convertible into 30 shares of common stock. What do we need? We need shares of common stock. So, mm, 30,000 bonds that are $1,000 par and 9% convertible. The bonds were originally issued at par, and each bond was convertible into 30 shares of common stock. This part right here is very important. Let me get some explanation from chat, because this part is what's missing. After that, that will be easy. As you say, easy peasy, lemon squeezy, but not really. It requires a lot of thoughts. A lot of thoughts into this, my friend. So, let me ask chat to explain that to me. Mhm. Explain that to me phrase by phrase, sentence by sentence, easy peasy lemon squeezy to make it make sense. Let's see what we got. See what you got, my friend. See what you got. Alright. So let's do what you've been doing successfully lately. Read the question like a detective. Yes. Like a detective. Don't solve yet, just understand what every phrase is trying to tell you. Yes. First sentence. During the year, Conoco had outstanding. Translation. These are the securities that existed at all year. Alright, these are the securities that existed all year. Let's go. The examiner is about to tell you or to tell us what kinds of ownership claims exist. Immediately your can't even speak. Immediately your farm brain should think, I am probably calculating EPS. And that's for sure. Next phrase, 25,000 shares of common stock. Translation, these are the regular shareholders. These people own the company. For EPS, common shares usually become the denominator. So write mentally, common shares, 25,000. Okay, we got that. Next phrase, 8,000 shares of 20 par, $20 par, 10% cumulative preferred stock. Let's break it apart. 8,000 shares, number of preferred shares, $20 par. Each preferred share has a par value of $20. 10% cumulative. This is huge. Cumulative means if the company misses a dividend this year, it's still owes it later. Preferred shareholders get priority. The annual preferred dividend is 8,000 times 20 times 10. We did that. Okay. We did that. Don't calculate yet. Just recognize. This is preferred dividend information, which we need. Okay? Preferred dividend. Preferred dividend usually reduce the EPS numerator, reduce net income. That's right. Next phrase. And 3,000 bonds that are $1,000 par and 9% convertible. This is what I didn't understand. Now the examiner is introducing another security.
decoded. 3,000 bonds. The company borrowed money from bondholders. 1,000 par, $1,000 par. Each bond is worth $1,000. Total debt, 3,000 times 1,000, that's 3 million. Wow. 3,000 times 1,000 is 3 million. So if you want to make $3 million, you get 3,000 people to pay you $1,000. What? Or you have 1,000 people to pay you $3,000. You make 3 million. This is amazing. All right, this is not what we're talking about. 9% interest rate. The company pays interest. The word convertible, this is the word that should make a foreign student stop. Convertible means bondholders can become shareholders. Yes. Immediately think this matters for diluted EPS. Yes. Not basic EPS. Diluted EPS. Next phrase, the bonds were originally issued at par. Translation, no premium, no discount, no amortization. The examiner is removing complexity. Next phrase, each bond was convertible into 30 shares of common stock. Translation, if bondholders convert, one bond becomes 30 shares. How many bonds do you have? 3,000. So you're going to do 3,000 times 30. Again, this matters for diluted EPS, not basic EPS. The examiner is giving you information that you probably won't need. Next phrase. During the year, net income was 200,000. Now we have the dividend and we have 200,000 net income. We know what to do with that. Next phrase. No dividends were declared. Okay, that is a trap. That's a trap. Remember, when they say no dividend were declared, that's a trap. This is the trap. Many students think, okay, no dividend declared means subtract nothing. Ha, this is wrong. The preferred stock is cumulative. For EPS, cumulative preferred dividends are deducted whether declared or not. The examiner is testing that rule. Next phrase. The tax rate was 30%. That's another trap, my friend. 30%. Another trap. Tax rates are usually used when adding back bond interest for diluted EPS. Example, interest times 1 minus t. But this is asking for basic EPS. So you probably want to use the tax rate. Final question. What about was Commerce basic earnings per share for the current year? This is the most important sentence. This is the question. That's what you need to find. The examiner is screaming basic EPS, basic EPS, basic EPS. Not diluted, not diluted, not diluted. Therefore, what information matters? Use net income, $200,000, preferred stock information, common shares, 25,000. Ignore convertible bonds. Conversion ratio, tax rate, because those belong to diluted EPS. What? I fell in the trap. Now let's solve preferred dividend. 8,000 times 20 times 10, that's 16,000. Numerator is 20,000 minus 16,000, 184,000. I got that. Okay. Denominator, 24,000 shares. So, basic EPS. What makes it screen basic EPS? final question. What amount was Commerce basic earnings per share, which is basic EPS? That's the question. The question didn't talk about diluted EPS. It talked about basic EPS. So basic EPS, you ignore all of this other information, the 9% convertible, the 3,000 bonds, the tax rate, all of these. Forget about all of these. You have no adjustment. It's 25,000 shares common stock. This is what you're going to use. Okay. Let's check again. Alright, whenever you see what is basic EPS, cover up all the information about convertible bonds, convertible preferred stock, stock options, warrants, tax rate. Those are almost always diluted EPS clues. For basic EPS, focus only on net income, preferred dividends, common shares outstanding. That's exactly what this question is testing. My friend, you got it. This is what it is. 736. 736. Ooh, this is good. This is good. This is good. This is really good. Who's studying here? Who is here studying? Nobody. No one is studying. Ah, fine. Okay. Let's get it. Let's get it. Let's make it happen. Time goes by so fast. Alright. Let's see this. Bumco had 100,000 shares of common stock outstanding as of January 1st. The following event occurred during the year. 4-1, since April 1, issued 30,000 shares of common stock. June 1, issued 36,000 shares of common stock. July 1, declared a 5% stock dividend. September 1, purchased the treasury stock 35,000 shares of its common stock. BUM used the cost method to account for the treasury stock. What is BUM weighted average of common stock outstanding at December 31st? That should be easy. So we have April 1 issued 30,000 shares of common stock. Okay. June 1 issued 36,000 shares of common stock. Okay. July 1st declared a 5% stock dividend. This is very important. Purchased as treasury stock 35,000 shares. This will reduce it. Bumco had 100,000 shares of common stock outstanding as of January 1st. So we start there. We had 100,000 shares outstanding starting the year, and then in April they issued 30,000 more shares. So April is the 4th month of the year. So that's gonna be 8 months remaining. Let's do it. So extra shares are, alright, extra shares 30,000 Alright, 30,000 times extra shares, 30,000 times what? Times 8 divided by 12. That's 20,000 shares, okay? 20,000 extra shares. 20,000. Extra. In June, issued 36,000 shares of common stock. Okay, so now what we're gonna do in June is the 6th month of the year, so we have 6 months left. They were outstanding only for 6 months of the year, so it's gonna be 36,000 times 6 divided by 12 months of the year. That's 18,000 extra. Plus 18,000 extra. Okay? Then we have declared 5. Let's do that first. So we have 100,000 plus 20,000. That's 120,000 plus 16,000. Okay? Or let's do 20 plus 16. That's 36. So that's 136,000. 136. Okay? 136,000. July 1st, declared a 5% stock dividend. 5% of what? Is it 5% of the 100,000 or 5% of 136,000? This is very important. I'm gonna do it 136,000. 5%. 136,000 times 0.05. That's 6,800. Okay. 6,800. So we're gonna add 136,000 plus 6,800. That's 142,800. 142,800. Okay. September 1st, purchased as treasury stock 35,000 shares of its common stock. BUM used the cost method to account for the treasury stock. So we have 35,000 treasury stock. This is when the company buys back its own shares. When they buy back their own shares, you subtract it from 142. So we have 142,800 minus 35,000. That's 107,800. Okay. 107,800. That's in the case the 5% belongs to the whole thing, but this is not available. I'm missing something. Let me see what chat says. I'm missing something. Okay. I'm missing something, my friend. See what chat says. So, step 1. What are they asking? What is BOM weighted average of common stock outstanding? Translation, we are looking for weighted average shares outstanding. Why so? That's what we're looking for. Step 1, starting point. January 1st, 100,000 shares outstanding. For January through March, 3 months. Okay? What do you mean? I thought that was a whole year. 100 times 3 divided by 12, that's 25,000. April 1st, issued 30,000 shares. New total, 100 plus 30,000, 130. These shares exist from April through May, 2 months. Step 4, June 1st, issued 36,000 shares. New total shares, 130 plus 36,000, 166. July, stock dividend, declared 5%. There's no new money entered the company, the pieces stay the same. Adjust price shares amount beginning. It's a little bit more complicated. Calculate January 26, 22, 139. It gets more and more complicated, my friend. More and more. But we're gonna knock it out. Gotta knock it out. Can't play with it. Alright. Step 2, starting point. January 1st, 100,000 shares outstanding. For January through March, 3 months, 100,000 times 3 divided by 12 is 25,000. Step 3, April 1st, issued 30,000 shares, new total, 100,000 plus 30,000, it's 130,000. These shares exist from April through May, 2 months. 130,000 times 2 divided by 12, 21,000. Step 4, June 1st, issued 36,000 shares. New total shares, 130,000 plus 36,000 equals 166. Step 5, July stock dividend. Declared 5% stock dividend. Stop. This is the most important event. Remember the rule, stock dividend are treated as if they happen at the beginning of the year. So everything before July 1st must be multiplied by 1.05. Why? Because no new money entered the company. The pixels stayed the same side, just cut into more slices. Adjust price shares, share amounts. 100,000 times 1.05, 105. April, 130. June, 166. 174. 26, September 1st, treasury stock purchase. Purchase 35,000 shares as treasury stock. Treasury stock reduces outstanding shares. New total, 174. 174, 3,300 minus 35,000, 139,300. Build the weighted average table. January through March, 105, 3 on 12. The fraction is 3 on 12. April to May, 136,500. This is for 2 months, 2 on 12. June to August, 174,300. That's for 3 months, 3 on 12. September to December, 139,300. That's 4 months, 4 on 12. Alright, everybody, we're gonna go on break and we will be back in a minute, in 10 minutes. Enjoy your break.
Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp with the great memory. Oh, come and study with me. Come study with me. May you pass every exam with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp. With the great memory. With the great memory. Come and study with me. Come and study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. May He give you wisdom. Critical thinking too. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp. With the great memory. With the great memory. May you pass every exams. Come study with me. Come study with me. Come and study with me. Come study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, One page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me. May you pass every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you got what it takes. You can win again. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Let it rise in you. Come and study with me. Hey! Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. With a great memory. Come and study with me. Come study with me. When the hours feel long, when the notes run deep, oh, keep your eyes on the goal. Keep your promise to keep. May God give you intelligence. Oh, may He give you wisdom. Oh, critical thinking too. Amen. Amen. Come and study with me. 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 You've got what it takes. You've got what it takes. You've got what it takes. May your brain be so sharp, with a great memory. With a great memory. May you pass every exams. Come study with me. Come and study with me. Come and study with me. Come and study with me. Let's master our craft. Let's work on our dreams. Come study with me. Come study with me. We open the books and we keep our feet steady. Let's master our craft. Let's work on our dreams. Oh, one page at a time till the whole room believes. May God give you intelligence. May He give you wisdom, critical thinking too. Let it rise in you. Come and study with me. Come and study with me. You've got what it takes. Oh, you've got what it takes. May your brain be so sharp, with a great memory. Oh, come and study with me. Come study with me.
Okay, let's go back to work.
May you passed every exams with grace in your hands. When the paper gets hard, you can still take a stand. No matter if you wanna be a CPA, MD, or RN, you can win again. May God give